Joining me is Mark Avallone. He's the president of Potomac Wealth Advisors. Mark, welcome to you.
Good to be here.
I guess one of the questions is how much of this is still, we've priced in a lot. Obviously, since the election, we're giving some of that back now. Where do you see the opportunities?
Well, the election changed the undercurrent that was happening. There was a lot of regulation. That's a cost for business every step of the way. There was concrete talk about higher capital gains taxes, higher corporate taxes. And when you include an opportunity to have less regulation, less tax on companies, less tax on corporations, and then you have a more benign mergers and acquisition environment, that's what we believe changed. It will ultimately depend on corporate America to deliver earnings, and they're going to deliver earnings through their continued efficiencies and the use of technology. And that's how we get to our thesis that continuing to invest in tech makes the most sense for investors.
And broadly speaking, Mag 7, I mean, sometimes you get names like Netflix or a Tesla in there. So which ones do you think are most attractive?
Well, we like the fact that there have been some headwinds against great companies like Microsoft and Google, and specifically the recent action against both of those companies and the huge overhang Google has in the courts from the U.S. government and elsewhere. We think that's going to go away. We think that Donald Trump loves a strong stock market. Yes, he likes to go after companies that he feels are a little unfair, but he likes a strong stock market and a strong legacy even more. So there'll be a lot of jawboning, and that'll keep a lid on these stocks, but eventually it'll be clear that there'll be a more benign regime out of Washington, and there'll be more talk than action against America's best companies.
So you like those Microsoft, Alphabet, Apple, kind of the big tech platforms, financials. You also like the mid caps, kind of some increased deal making. They could see some extra premium there. Can we talk defense, Mark? I mean, that's an area we've in the past thought, okay, beneficiary of kind of the conflicts breaking out in the world, kind of a steady place. Now a lot of that is being called into question, and these stocks are down big.
Well, they're down big in the past few days. If you look at companies like RTX, well up over 30% in the past year. Lockheed not as strong, but still solid. And unfortunately, global conflict is not out of vogue. And we're firing off missiles, we're flying drones, and the companies that make those and the defense systems against that sort of warfare is going to remain intact. I know valuations are higher than they were a year or two ago when we started talking about this, but until we see a more peaceful environment, we're going to continue to think this is not only a good investment, but a hedge against tail risk. What could bring the market down is this global uncertainty. Owning defense stocks gives you a little bit of a hedge against that.
Are there other areas that you think are unattractive here, either because of valuations or, event risk now?
Well, I think there's uncertainty in healthcare. Healthcare has been lagging, continues to lag. It's also a very heavy it's full of regulation, which slows things down. I've been really surprised that the medical equipment manufacturers, some of them have lagged, even though I would think demand with an aging population would have made them more attractive. But when you have a regulatory overhang and politicians banging on them for price, and now with the recent nominations that we've seen, not so sure healthcare is going to be a growth engine. And that's not an area we're really high on.